Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. Today's guest is the author of the Doomberg Substack, one of the most widely read finance newsletters on the platform, where he writes about energy, finance, and the economy at large. Today, we're going to be taking a look at the macro outlook and ask some big picture questions regarding the energy space. It's Doomberg. Welcome back to the show.
Jesse Day, good to see you again. Great to be back.
Yeah, great to have you back. And I want to start with a bit of a broader question before we focus specifically on energy. And that is, what are the main trends and events you're paying attention to currently when it comes to markets, the economy, and geopolitics as we move into 2024?
I would say we're following three major events. Obviously, the war in Ukraine and whether and how that might come to a resolution is top of mind, and I think pretty consequential geopolitically. And I think being very poorly reported in the West, much to the detriment of the public's acceptance as to what is likely to transpire in 2024 and beyond. Obviously, the second is the conflict in Israel and Gaza, and how and whether that spreads beyond Israel and Gaza to a broader Middle East conflict. That remains to be seen. We are seeing a bit of risk to that effect, especially vis-a-vis the U.S. and Iran. Although, again, I would say the response from the Arab world has been pretty interesting. And then the third, we have, of course, been following the farce that is COP28 and the readout from that event. And of course, for anybody interested in commodities, that's something to keep a close eye on. But if I had to rate them in order, those would be the three things that we're following for geopolitical impact, at least in the next few weeks and months ahead.
Great. A lot of follow-ups I want to have there, but I do want to focus on energy. We definitely will get to some of the ESG madness that is going on as well. So I'd like to ask the same question, but specifically for the energy space. What are the main themes you're watching when it comes to energy globally at the moment?
I would say, as we have written about in our November Doom Zoom presentation for our Pro Tier was centered on, we're watching the natural gas market very, very carefully. We are seeing the beginning signs of a potential glut in liquefied natural gas, as is all too common when we see an extreme shortage in the years ahead. Industry, as we said in our piece, often draws tangent lines to sine waves. They think upswings will go on forever and downswings will never reverse. And as we pointed out in both our Doom Zoom presentation and in our piece, Liquefied Natural Glut, that can be a tailwind, sorry, a headwind for the other commodities in the energy complex, especially coal. A little bit less so with oil, but to the extent that primary energy sources are fungible to any degree, a glut in one usually spreads to the others. So that's the one thing that we're watching. The second thing that we're watching is what I believe is really the beginning of the nuclear boom. One of the things we saw from COP28 was what we think is, or what we're calling the final defeat of the old school Malthusians and their opposition to nuclear power, which has essentially become untenable in the modern environmental political debate. And then, of course, watching what's going on in the shale patch in the oil sector, and whether or not OPEC Plus will be able to maintain discipline in the face of ever increasing volumes flowing out of the shale patch. We're currently working on a piece titled "Peak Cheap Oil is a Myth," at least that's its tentative title, where we explain how, if you think about oil as hydrocarbons, we're nowhere near peak cheap hydrocarbons. And so those are the sort of the main things that we're watching as we wrap up the year. And of course, finally, we're keeping an eye on the weather in Europe, which seems to be trending just about average, which as each day passes, removes sort of worst case scenario risk for that region. And then once they get through this winter, I think on the European energy crisis because the market will have fully adapted.
Great. Well, I'd like to pull on many of those threads which you just mentioned, and perhaps starting with natural gas, because in a recent article on your Substack, the one you just mentioned, you said that you performed a deep dive into the natural gas markets and what you found should give energy bulls pause. Could you expand on your findings and explain why maybe people shouldn't be so bullish on natural gas at this point in time?
If you look at the Permian, for example, natural gas is an unwanted byproduct, so-called associated gas. The rate at which natural gas is being produced in the Permian is exceeding the US's build out of LNG export capacity, which is why you see natural gas stuck at basement level prices in most of the US, at least parts of the US that are interconnected with the natural gas producing regions of countries. So you would have to exclude New England and California. When I say US, I mean the same US, not the crazy coasts. But that is just one example of more natural gas coming online than the world can use. If you look all over the world, with the exception of Australia, which we can talk about at the end, we are seeing the construction and near commercialization of a boom in new natural gas capacity and, in particular, liquefied natural gas export capacity. So, up in Canada, that giant project that has been so over budget and so controversial, sunk cost notwithstanding, that project's coming online probably in 2024. The giant Arctic LNG 2 in Russia looks set to begin cargo deliveries as early as January of this year. Qatar is building out probably somewhere between 6 to 7 billion cubic feet per day between now and the late 2020s. They have, of course, in their possession, shared possession with Iran, the largest natural gas field in the world by a wide margin. The US, of course, is looking to expand and ramp up its LNG exports for the reasons I've already described. And Saudi Arabia, which has been a laggard in the natural gas space, is spending something like $110 billion to develop a massive natural gas field in its possession and is pondering participating in the LNG export markets both directly and then indirectly through a series of investments. And so everywhere in the world, we're seeing all at once, you know, the coming online of major export capacity. And as you know, commodity markets tend to be relatively inelastic, and it doesn't take much of an excess supply to create glut, nor does it take much of shortage to create panic. But we're seeing, especially if the winter in Europe continues to be relatively benign, the emerging shaping up of a bit of a glut here in the natural gas market. Now, the one exception is Australia, which has almost as crazy a domestic natural gas policy as the U.S. And despite being one of the world's top 3 natural gas exporters, it is busy building LNG import facilities along its southern coast because domestically it's facing a natural gas crunch. And to the extent that cargoes that had been seeing action in the global markets are redirected for domestic use, that could be a tailwind for natural gas prices. But I believe that one exception will be swamped by the massive amounts of natural gas that are coming online. And then finally, I will close with why we're keeping one of the reasons why we're keeping such a close eye on the Ukraine situation. You know, there still exists substantial land pipeline that connects the prolific natural gas fields of Russia to Europe. They're largely underutilized today in a world where, by some miracle or a rightward tilt in European electoral politics, peace were to break out. And rapprochement with Putin is made. If those pipelines are turned back on, imagine what happens to global natural gas prices in that scenario. We have to call it as we see it. We are long-term energy bulls, but that doesn't mean that you have to always be long. You have to take a look at what's going on and adjust accordingly. And with natural gas, we are seeing a substantial excess supply coming online.
Well, let's now shift to the Malthusians capitulating on nuclear energy because there is now a real political push in Germany to restart some of their nuclear reactors. I'm going to quote an article here from NukeNet that says 3 German political parties have called for a reversal of the country's anti-nuclear policy, with leading members of the Christian Democratic Union, the Christian Social Union Alliance, and the Liberal Free Democratic Party saying they want to restart decommissioned reactors and build new ones. Certainly a good sign, but it remains to be seen how this all plays out. How much power do you think these political parties really have? And could this be the turning point for Germany to pivot back to nuclear?
So there's Germany and then there's global nuclear. And we can start with Germany, but I think the real headline in the past few weeks has been the ongoing um, normalization of nuclear power as a quote unquote clean energy source. And I think one of the most important outcomes from COP28 was for the first time, um, nuclear was included amongst a suite of technologies that the world is officially describing as clean. This is consistent with what we're seeing in the Biden administration. Another major readout from COP28 was this assembly of 22 nations who have jointly committed to triple nuclear energy collectively. This again was an initiative led by the Biden administration, and we should applaud their efforts in this regard. And frankly, Germany, to your question, is rather isolated in this regard now. And I think the ruling party in Germany is on its last legs. I think we could see a collapse in that government, and who knows what the next government will do. And this is one thing that we have cautioned our subscribers on. Whenever you see headlines that just don't make sense, like we've recently seen in the state of Michigan, where we wrote a piece called Michigan's Waterloo, all of these decisions will ultimately be reversed by future legislatures or congresses or parliaments. And we expect that in Germany, enough pain has been felt. The deindustrialization of their economy has been pronounced. We're seeing a surge in right-wing politics, and we've been warning about this for a long time. And yes, I think the final victory will be when Germany capitulates and pivots. But the nuclear sector doesn't need that to flourish. I think the momentum behind the nuclear industry is as strong as it's ever been.
Absolutely agree with you there. I want to shift to Canada, where the Liberal government has announced they will be placing punitive measures on oil and gas companies by capping emissions from the sector. This is from an article on CBC. The Liberal government's framework to cap emissions from the oil and gas sector proposes to cap 2030 emissions at 35 to 38% below 2019 levels in order to reach the government's goal of reducing emissions in the sector to net zero by 2050. But meanwhile, the Canadian Association of Petroleum Producers has warned of unintended consequences of the framework that could result in significant curtailments, making this draft framework effectively a cap on production. Do you think this presents a real risk to oil and gas companies in Canada, particularly if investors get spooked by this sort of rhetoric? I believe this policy is set to be implemented in 2026, so still a little bit of a ways away. But do you think this is perhaps a signal that investment in Canadian oil and gas companies could slow down up ahead?
I wouldn't necessarily take that view. I think the most important thing you said is 2026, and there's a giant event scheduled between now and then, which could happen at any time that the NDP party decides they want an election. Justin Trudeau is trailing badly in polls, last I saw. Just over the weekend, I was reading that the Canadian government has signed a new phase out of electric vehicles, a phase out of internal combustion engines by 2035 to be replaced with electric vehicles. At the same time that Germany is scrapping its EV subsidy plan literally overnight and doing a complete about face on the policy. It's almost like leaders in the West are 5 years behind Germany and can't see the consequences of their policies being played out in a country that is really struggling right now. Now, there are 3 things to consider. There's the election. And I do think, like I said in my previous answer, such policies can be easily undone. Second, there's the question of Alberta versus Canada and what the province of Alberta will do in this regard. And we're starting to see, as crazy as it sounds, the beginning of some successionist talk in the province and a bit of sort of insurrection to use a loaded political word in the US here. Within Alberta, vis-a-vis Ottawa, there's always been simmering tensions between the sort of the producer provinces and the rest of the country who benefits from such production, but yet still pretends as though they don't. And then I would also say a fair bit of those quote unquote emissions reductions have to do um, with abating methane leaks, which was one of the big readouts from COP28 as well. And industry should actually work on that and could probably obtain much of the draft proposals objectives in that regard. And of course, industry is always going to complain uh, whenever the federal government tightens restrictions. But I would fade Justin Trudeau's political power. I would go long Alberta's energy independence, and I would go long the industry's capacity to find ways to work with their partners in government, keep the lights on. I think we're past. We're putting together for December for our approach here a Doom Zoom presentation called "Coulda, Woulda, Shoulda." Doomberg's readout from COP28. That the first conclusion is we're really probably peak ESG, and Justin Trudeau is late to being notified that the party's probably over. But we expect him to exit stage left here within the next 12 to 18 months.
I definitely hope so. Saskatchewan, the premier Saskatchewan, also pushing back on this emissions cap as well. So yeah, I think in the long run, perhaps too much is being made of it in the media. I did want to discuss the weather situation in Europe. You mentioned that's something that you're paying attention to. Last year was a seasonally warm winter. They stocked up on LNG. They were able to get a lot of it. How do you think their situation currently stands in terms of both their LNG reserves and the way that you see the weather possibly occurring over the course of this winter?
So I'm not a meteorologist, but I do have access to the internet, and there's a wonderful website called Weather Spark, which we use. And if you type in your city anywhere in the world, it gives you sort of the trend of your temperature readings versus sort of 25th, 75, or 90-10 percentile rankings and bands. And we just follow Frankfurt, which is our proxy for Western Europe. And just eyeballing that chart today before jumping on the air with you, it looks that we are trending right down dead center average winter, not particularly cold, but not particularly warm. And, if we could get through the next, say, 6 weeks in a similar trend, then I think then they would have survived yet another winter, thankfully, by the way. And the crisis will be well and truly over. Now, there are lots of things that could interrupt that. A war in the Middle East, for example, terrorist attacks on natural gas infrastructure. We're becoming dangerously close to normalizing such activities. And if the war in Ukraine escalates, or there's all manner of geopolitical shocks that are impossible to predict that could change the situation. But all things being equal, we think that the Europeans have once again been bailed out by the weather. The whims of Gaia continue to smile upon the European continent, which is an unabashedly good thing.
Absolutely. And you also touched on US shale oil production earlier. So I'm wondering what your thoughts are there, because a lot of people who are long oil and bullish on the energy sector point to a terminal decline in the rates of production coming from the shale oil patch in the US. Are you seeing the same thing? And is it a major catalyst in your view for oil moving forward?
Yeah, as I mentioned earlier, we're working on a piece in this regard, and I reached out to my good friend Luke Roman weekend because he once again had written about peak cheap energy or peak cheap oil, and many people had pointed out that our analysis was in contradiction to the team at GNR, who have been putting out some pretty bullish sentiment. We have just a diametrically opposed view at the moment. I think the U.S. just set a record production. What do people who see in the drilling data? And by the way, we've made this mistake in the past, so there's no judgment here. We're just giving a different view based on our read of the data. They constantly underestimate the impact of technology and progress, and so comparing current rig counts to historical rig counts fail to address the fact that drilling has become 40, 50, 60% more efficient in the past 2 or 3 years, and so historical data just doesn't mean what it used to. And in fact, one of the things that people point out for making the sort of the bullish case is that yes, the U.S. has reached a new record in the production of oil, but that's only because the DOE has redefined, natural gas liquids to be oil. Well, they are oil, and as we'll point out in our piece, like anything that goes into the refineries should be counted as oil, because this displaces the need for oil in other areas. And the 2, 3, 4% moves, really matter. So, for example, natural gas liquids can be used as a diluent for heavier oils to make lighter grades, or the entire, not the entire. Many chemical crackers are flexy and can pivot from, say, naphtha to natural gas liquids depending on prices. So, anytime you're introducing highly useful hydrocarbons into the refining network, you are in fact increasing supply. And so, and of course, in the U.S., there's a lot of private actors who aren't beholden to the hoped for newfound capital discipline coming out of the crash of the oil prices, in the post-COVID era. And so, when taken together, we see we'd be bullish production in the U.S., but that's not necessarily bullish for prices globally, which is why you're seeing OPEC Plus continue to argue internally about whether or not this is a war that can be won. And look, this is something we have been calling for. Like, our whole issue around Russian sanctions has been, we need to outproduce Russia. We need to drive prices lower if we want to achieve our geopolitical aims. And so investors need to ponder the geopolitical desires as well. And it's no coincidence, I think, that we're seeing issues pop up in Venezuela and so on. But by and large, we would not. We find it difficult to find in the data correcting for technology the same conclusions that other brilliant analysts that we respect greatly have come to.
Very interesting. So I'm wondering if you're bullish on the price of energy for the long term, looking out, let's say, a decade. Are these headwinds that you're mentioning for the price of oil, natural gas, and you also mentioned coal, which I want to touch on a little bit later, are those more in the shorter term, and are you bullish long term, or do you think lower prices over across the spectrum of when it comes to fossil fuels will continue for the foreseeable future?
Oh, I think long term, you have to have a bullish outlook. I would say that our view of the energy market is an upward sloping line, overlaid with a sine wave. You have sort of local highs and local lows, but overall, global primary energy use continues to grow at roughly 2%, 2.5%, which is global GDP. It's no coincidence, because energy is life, and you can't grow the economy without energy. And in fact, we would be bullish on the U.S. economy. There's a lot of mystery out there as to why it is that the U.S. has not slipped into recession yet, despite spiking interest rates, and maybe they will still. But I would argue that at $2.25 natural gas and an abundance of it, it's kind of hard to drive into a recession. It is so much of the economy that relies on natural gas as an input. Virtually every brownfield site in the U.S. has a cogeneration facility fired by natural gas that produces both electricity and industrial grade steam. And if you can tap into 2.25 per million BTU natural gas, but get to price your products globally, where everyone else is paying much more, that's a pretty good competitive advantage for the manufacturing sector here in the U.S. And so we would be, I would say, medium term, next 6 to 12 months. Again, absent some geopolitical shock, which would, all bets are off. We would be particularly cautious, I would say, and we would be looking for entry points near the bottom when we see peak capitulation, which we're nowhere near now. And then, as for coal, I just want to touch on that. Coal trades, if you look at sort of on an energy content basis, to a rough approximation, what we're seeing is LNG prices trading in line with oil prices. That's because in certain parts of the world, oil and natural gas are both burned to produce electricity, and they're highly switchable. And so we see that. And then what we see is coal trending towards the floor price of U.S. domestic natural gas on an energy content basis. And so coal would be the biggest secondary loser of an LNG glut, because the world is switching from coal to natural gas, of course, outside of the developing world. But places like China are pretty shrewd in their acquisition of coal. They have massive stores of hydropower that they can flex in and out, and they're also building out natural gas as well. And so I think coal would be the biggest secondary loser of a natural gas glut. Oil is still needed for a variety of reasons and things that natural gas can't directly impact, and so it would be a little more buffered from that. But if you're waiting on discipline in the shale patch or the turning of the rig counts to save you, you'd have to see much lower oil prices than this for that to happen.
Well, I would like to follow up on coal there because you posed a very interesting question in a recent Substack article you wrote, which is, what do precipitation levels in Sichuan have to do with the price of coal in Appalachia? Could you let us know what the answer to that question is and why?
Yeah, there's a great Substack article that we quoted in that piece. One of the wonderful things about Substack is you can read thoughts of experts from all over the world, mostly for free. And the good stuff is behind the paywall, but at least you can get a taste of what's out there. And we came across this Substack whose name escapes me now, but you can find it linked above the paywall in our piece that references it. Um, it's fascinating. So Chinese hydropower, which I didn't really internalize until I read this article, is 2% of all global energy consumption, all primary energy consumption. In fact, Chinese hydropower is roughly the same size of Germany's entire energy budget and greater than all but 10 countries' energy budgets around the world. And so if it rains a lot in southern China, um, the provinces in the region no longer need to participate in the coal market to the extent that they have been. And rain in China causes a depressed coal price. Well, because primary energy is largely fungible, that puts downward pressure on the price of coal in Asia. And since coal is a globally traded commodity with really tight logistics, that puts downward pressure on the price of coal worldwide. And that, of course, puts downward pressure on the price of natural gas because, again, they're fungible. And so no, I hadn't realized just how big Chinese hydropower was and how tightly interconnected it is to the coal market until reading that Substack. And that was the opening story for our piece around the liquefied natural gas club that we see potentially emerging. And I wanted to give a shout out to that author. It's a smaller Substack, audience-wise at least, from Doomberg, and I thought it was a really fascinating point to make. And so I was happy to share it with our audience.
Yeah, very fascinating. I recently interviewed Steve St. Angelo of the SRS Rocco Report, and he has what some consider to be a pretty extreme view on the energy space, and that is that he thinks supply deficits, along with increasing demand from emerging economies, will lead to a situation by 2025 where new production will just not be able to keep up with demand, and we will fall off what he calls the energy cliff, sending prices soaring and creating dire implications for the global economy. I'm wondering what your thoughts are. Are you seeing that extreme of a shortfall up ahead? What do you think about his thesis?
Not having seen the totality of his work, but based on everything that we said today, I assume that you would probably know that we would fade that prediction. Embedded within the prediction is the cure, which is soaring prices will crush demand in the emerging economies rather quickly. They're the most price sensitive buyers. And so ultimately, again, the things that drive extreme price spikes in the energy complex are shock geopolitical events. So much to our surprise, when Putin moved on Ukraine, that drove the next leg up in the energy prices. If war were to break out between the U.S. and Iran, absolutely, that would be very, very bullish for energy prices. If certain navigational waters were blockaded, if the drought in the Suez Canal continues unabated, there are all manner of geopolitical shocks that could make such predictions come to reality. But those are hard to forecast, and we would just have a different view based on, especially this global look. And we did a very, very detailed analysis of the natural gas market, all over the world. 55-minute presentation, and it's coming. Coal production record levels, natural gas production record levels, oil production record levels. On top of that, we are still building up the renewables, and we argue that any primary energy added to the global grid is additive. It doesn't displace other energy sources, and so soaring energy prices will crush emerging market demand first, which is what we saw with the natural gas crisis. Countries like Pakistan and so on were left out in the cold, literally. And so we would fade that prediction, but with all due respect to Mr. St. Angelo, I'm sure has his own reasons for believing that to be true.
Awesome. Well, Doomberg, it's been a fantastic conversation. I always love talking with you. Before I do let you go, for those who want to learn more about your Substack, tell us about it. Where can people find it, and maybe give us some more details on the type of articles you write there.
Yeah, really appreciated the conversation, and thanks for the opportunity to let your listeners know where to find us. Everything that we do can be found at doomberg.substack.com. We are the number one paid finance Substack in the world, which is an amazing thing to say. We publish between 6 to 8 articles per month to our regular subscribers. Free subscribers get a preview to each of those articles and the occasional free one. And then our pro tier, in addition to those articles, we have a monthly Doom Zoom session where we either do an in-depth presentation like the natural gas one I referred to, or the upcoming one we're going to do on a readout from COP28, or we have high-profile guests do the same. And so everything's at doomberg.substack.com. We're active on Substack Notes, which is sort of the Twitter equivalent is the wrong word, but similar to Twitter, but under the Substack umbrella. And Jesse, hope you have a wonderful holiday season. I know it's late there for you. It was great to have this discussion, and I'm looking forward to coming back anytime you'll have us.
Awesome. Well, thank you so much. I will put a link to the Substack in the description below. As always, great having you on, and definitely looking forward to chatting again in 2024. And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.